Okay, we are here, Chris.
A very good evening, good afternoon, or even good morning maybe for you. Welcome to Admiral Markets Range Trading's webinar. We're glad that you can join us today on the Thursday, 29th of August, and we're looking forward to this topic. Before we do that, though, we're going to take a look, of course, at some interesting topics, such as, for example, the great spreads that you can see here and the market depth at Admiral Markets, and for example, buying and selling direct from NG4. Here's just a screenshot I added to give you an example of what kind of pip sizes we're looking at: the euro dollar half, but not only the euro dollar, the Aussie dollar 1, dollar CAD lower than 1, just to give you an idea. The risk disclaimer explaining, of course, that trading for exchange and in global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this video and webinar is for educational purposes only. So I do thank you for your attention on that. And before we start our webinar, I do want to welcome Michal.
Good afternoon or good evening, everybody. Thank you very much for a lovely introduction, Chris. I'm pretty sure today's topic is once again going to be great. I say hello and good evening to everyone who decided to participate in this webinar. I will now change everything to my screen. I hope you can see me just fine. And let's start with our webinar. My name is once again Michael Onahov, and I'm a Client Relationship Manager for Admiral Markets. If you would like to reach me, you can always email me. Yes, email me, call me, or find me on Skype. My Skype is Michael Onahov, and you can always reach me on Skype and ask me any questions you want about opening accounts in Admiral Markets. Also, you can always Google my name to look me up on LinkedIn and add me as a connection there. I'll cherish it very much. Today I wanted to speak to you about something that applies to everybody, to every one of you. It's about the new world you're about to enter, the world of finance. You want to understand the process better. This is why you came to this webinar. You want to be successful. You're interested, you're intrigued, you want to become a Forex trader. Some of you are just interested. Some of you have some experience with Forex, while some of you trade regularly and have their fair share of losing trades when you just end up looking like this guy, and good trades when you're more like this guy. From those two guys, given a chance to choose, every one of you, every single one, would like to be this guy. Both of them have a very good suit on, a fancy watch, but only one of those guys looks genuinely happy. It's this guy. He has closed a great trade and he's tasting success. I can bet it tastes very good, and I bet all of you want to taste it every day, every hour, and every minute. This is why you're here today, to get better, to get ahead, to be just like this guy. But what do you do to get there? Forex is not a walk in the park, let me tell you. To be successful in Forex, you must be able to swim with the sharks, and swimming with the sharks is one hell of a job. A job that requires courage, strength, and of course, plenty of training. So how do you train for a job like this without, say, getting eaten or losing money? Well, that's how. You get yourself in a position where you get a first-hand experience with no risk. You see, this guy is swimming around the sharks, but he's perfectly protected. And this kind of experience, well, it has a name. The name is Admiral Markets Demo Account. Trading Forex requires a lot of practice. Look at this typical Forex setup. It actually reminds you of something. That's correct. It reminds you of a plane cockpit where the pilot sits. Look at all those dashboards and all those screens. They look pretty similar, don't they? And when a pilot is getting trained to fly a plane, they must get familiar with the aircraft. In the same way, you must get familiar with the market. Admiral Demo offers you a MetaTrader, the most popular trading software in the world. And it is the most popular for a reason. It is the best. It offers tons of features for both Forex rookies and professionals. It will be your wings. It will be your path to victory. Becoming a Forex trader is, like I said, is like becoming a pilot. You must be able to make decisions fast, and your decisions must be correct. The pilot is responsible for the passengers. You will be responsible for your money. You're now a pilot of your own Forex career. Before a pilot is allowed to fly, he spends hours trading on a flight simulator that looks just like this. They get familiar with all the features of the aircraft. They put themselves through a variety of different scenarios, so when the pilot flies a real plane, they can make an instant decision when a situation occurs. A simulator just like this one, it costs a lot of money. You get yours for free. Your simulator is called Admiral Markets Demo. It takes less than a minute to register. You get to test yourself on real market conditions for free for as long as you want with absolutely no risk. You have learned and you will learn new things constantly, especially at a webinar which is going to be hosted later today by Tarantula and Chris. But after the webinar has finished, go to Admiral Markets website and download a demo account and put everything you've learned into practice. You can trade currency pairs or CFD on commodities and equities. Our spread, in fact, is so small that you wouldn't even notice it was there if I just didn't tell you about it. It's 1 pip on all major pairs. That's correct. That's 1 pip on all major pairs. Admiral Demo will get you a chance to see for yourself. So once the webinar is finished, you have plenty of new things learned. You're buzzing to test them out. Go to the website, get yourself a demo account if you don't have one, and start trading with no risk. Thank you very much for listening. I will now pass the microphone to Chris and Ninat. Once again, if you want to reach me some way, you can always email me, call me, find me on Skype, or just Google my name to get me on LinkedIn. It's been Mikhail Onahov. Plenty of learning ahead. Thank you very much.
Thank you so much, Michai. Great stuff and very wise words here from our Michai. Thank you so much. We're going to take a look at our topic and implement actually the words of Michai and learn from range trading. I do hear an echo, by the way. I'm not sure if I'm the only one. It could be maybe because of a stereo sound here in the background. Michai, maybe it's your side. I'm not sure, or is it you, Nanette? Normally we don't have any problem.
I don't hear any echo. Fine with me. If you
don't hear any echo. Okay. Yeah, the others do hear. The others do hear echo. Adrian and others.
I don't know why.
I think it's Michai. Michai, are you still there?
No, I think he went out.
Because maybe he has the...
When Nana talks, no echo. Well, I think that maybe you should, I don't know, shut off all of your background programs, maybe.
I think it's... I don't think it's my side, but I wouldn't know what it is. Can you try to put it on mute? Let's try that.
I'm hearing like some sort of ticking in your background. Now it's off.
Let's see. Why don't you try to put it on mute?
Me? Okay.
Yeah. So yeah, now I don't hear it. Does anyone else hear it? No, indeed. Okay, now it's gone. So that's better. Good. That's what I was thinking that could be it. So today we're going to take a look at how traders can profit from ranges or range trading. So we're going to take a look at what is trading and the advantages and disadvantages of that, then compare that to trending, and then taking a look at some examples as well, of course. So, well, first of all, the definition. I'm going to give you some tips, and then Tarantula is going to continue with that. When do we actually apply range trading? Well, of course, in fact, trading a range means that there's a lack of a trend. Last week we talked about the fact that we were trend reversing trading, right? So we're looking for trend reversals, looking at maybe tops and bottoms and key levels where a motion of a trend would stop and reverse at that level, and how we could trade that reversal. But that was assuming there is a trend, in fact, and we're either trading in with or against it. But the range is in fact differently. It's where we don't have a trend, where the price is going sideways in a tight or at least a compacted zone usually, right? It's two specific levels, a high and a low, where price is bouncing up and down between those levels. So here, for example, top and bottom, and then up and down like this. And price cannot break more or less that region of the high and low, although you have once in a while some peaks, small peaks through that zone in real life. That is the principle that explains the range.
So guys, let's start with range trading. Yeah, let's be honest. I don't like range trading, and maybe this webinar will differ a bit from others' webinar because we want to give you, want to present you a forex market sincerely as we can do. So I will, whatever you will hear from other traders, you need to know that this webinar reflects my and Chris' personal opinion, and especially when I do the presentation, this is purely my view for range trading, and I will pass you my experience, how I do it if I decide to trade range. But mostly, if you've been following me on Forex Factory and Admiral Markets and other websites, if you've been following me, you know that I'm a trend trader, and you know that I don't recommend range trading. Range trading is one of worst nightmares of traders, because I personally lose money when there is a big range, because I like to trade breakouts, and breakouts and range trading are the worst enemies. Also, trend trading and range trading are on enmity, So I really prefer only trend trading. So I will explain you why is that so. So range trading is a trading.
I'm also, by the way, definitely focused on trend trading myself as well, and also primarily focused on breakouts. So I have the same situation here.
Yeah, and the thing is, other presenters and other webinars, you'll probably hear, let's go range trading, I will learn you. Those kind of things probably, in my opinion, serve to take the money away from you. You will pay for a course that will teach you how to range trade, but we don't do range trading. Why? Because range trading is accumulation phase. We don't trade accumulation phase. We want to position ourselves. We don't want to bounce off of support and resistance. You know the style. You will make more money. You will make more money if you go with the trend or exploit breakouts. Range trading. Let's start. I made some digression, but I just wanted you to know how sincere we are when we do our presentation. So, range trading is a trading which identifies Forex pair channels. So Forex pair channels are basically the simple channels which will define the range. If those channels are going upward, we are talking about uptrend, so that is not trend trading, that is not range trading. If the channel is going downwards, that identifies a downtrend, so that is not a range tradable pair. Range tradable pair is 90 degree, it's flat, flat. You need to have a pair which goes flat. That means bouncing off the support and bouncing off the resistance. So range trading is a flat trading. It's based on buying at the bottom channel, lower level of support, and selling higher at the top channel, higher level of resistance. So this, what you see on your screen, is the range. That is accumulation phase. That is the first cycle, first thing in market cycle. So most of traders don't trade a range. They want to position themselves, put a big stop loss, and go with the trend. We trend traders want to see the trend has already been formed, so we exploit usually the first swing to the upside, to downside, or breakouts. So range trading, it's a non-directional strategy which is based on assumption that price does not trend. It may be the truth, because let's say 65 to 70% price is ranging. But you need to ask yourself when the price is ranging. Usually, in London session, the price is not ranging. Usually, in the beginning of cross session of London and USA, the price is not ranging. The price usually is ranging over the Asia session, which is very long. It starts around 12 midnight, let's say, and finishes around Frankfurt Open. So it's 8 hours of a possible range. And when we are talking that the price usually ranges, yes, indeed, but usually during the whole Asia session, or usually during the non-volatile times. Non-volatile times are times where banks are having their holidays. Non-volatile times are pre-NFP trading hours. Non-volatile times are times when the market is waiting for the big news. So,
or any Christmas or big holidays, for example, days off, public holidays, Christmas period, but also the 4 hours, I don't know if you mentioned it, the 4 hours before Asia, actually, between New York close and Tokyo Open. I think there are 3 hours, if I'm correct, where
also,
really
yeah, you're correct, Chris.
Yeah.
So after 8 hours of, let's say, our standard time, or let's say 7 o'clock GMT, there is no trend. There is only a range. So people will tell you, and traders will tell you, that you can exploit the range because price is ranging 70% of the time. Yeah, but when? It's usually when we don't trade, right? If you follow your marketing and your Forex trading strategy, you won't trade around 8 o'clock, you won't trade around 9 o'clock, you won't trade, or you will trade if you need Asia, but you know Asia is small. Sometimes it gets good, like maybe yesterday, and usually the range is very small. Also, you don't have a trend. Will you trade on bank holiday days? Of course, if you've been listening to us, you know that we don't trade on bank holidays. Will you trade pre-NFP? Of course you won't, because you will usually lose. So when others tell you, okay, I will teach you how to do range trading, it's simple. You don't need to pay for that. I will show you how you can trade ranges, but the biggest problem is you need to know when real range is getting started. Because if you miss the range, your account will get burned, because you will have a breakout, then that breakout will have a retest, that will usually be a start of a new trend, then that new trend will start to be maybe a bigger trend. So you know it's simple. If you don't know how to do it, don't do it. So I will give you pros and cons of range trading, and at the very end of the webinar, I will show you a pure and simple way how you can trade range if you want to do it. But I rarely do it. So range trading finally uses channels and or pivot points. There is no other indicators on range trading. So the biggest thing, sorry, this is my phone. The biggest thing is that you don't use any indicators to give you a signal when range is starting, because there is no indicator which can tell you that there is a ranging market. Don't search internet for that. Don't use forums for that. There is no indicator which will give you the exact range, which will tell you, okay, now it's range, start to trade the range, because everything is fake. You do it by your naked eye or you don't do it, right? So you can see it by yourself. You don't need others to tell you. You don't need any indicator to tell you, because there is no indicator. For range trading, you need to have a clear mind, you need to have your charting platform, and you need to see it. You need to spot it by yourself. If you follow my analysis, I usually tell you when there is a range-bound market, and I usually tell you, okay, you can trade when that level breaks. Today we had a breakout. If you been reading my analysis today, I was telling you exploit the retracement or a breakout. breakout of 32.50, and we saw it. 32.50 led the price to 32.20. It was good. It was good for 30 pips. If you went just above 32.60, well, it was, again, it was okay. But I don't need any indicator to tell me that.
Actually, no, that's a coincidence that you said it, because we're today looking at the pound dollar in our trading session, and it made a bit of a down move, a few pips there. And at that time, I was already saying the likelihood of a triangle being built is very high. This is exactly what it did. It was an A, B, C, D, E, very extended. We were looking at a 5-minute chart, by the way, just that you know. And it really got into a pretty big triangle for a 5-minute world. So yeah, you have to see that. I mean, we will have slides later on showing examples where, for example, the classical stochastics, you know, is in theory kind of the general idea that would give the top of the range. So we'll give a few examples like that. But in most cases, yeah, the experience is always the best, definitely. So here's maybe just
the experience is always the best.
Exactly. No, go ahead. Go ahead.
No problems, Chris. You continue. Go on with the example. I will continue later.
Okay.
No problem.
Here are just some examples, I guess, so you have an idea. Well, you probably know that already, but here you can see the tops and bottoms. Sometimes, of course, a range is more of an area than an exact level. The market isn't often that precise that it would be to the pip. Sometimes it is. So this is another example. Here the tops are also quite precise, but you can see there's a few pips difference. Here too, there are kind of two levels at the bottoms where what price is using as a support level. By the way, the first example is a euro-dollar 1 hour. The second example is a dollar CAD daily. So you will see the ranging and trending environments, of course, on all different time frames. In fact, what could be a range on one time frame, if you zoom out, could actually be part of a trend on another time frame. So that's why multiple time frame analysis is actually quite useful, and that's why we had a webinar on that topic as well. So that's definitely worth the viewing of that. So other descriptions, just in case you might be wondering, other people call the range consolidation zones, choppiness, sideways moves, zones or boxes, or rectangles, or even supply and demand zones. But that was a range in the past, and price is coming back to that level, basically. Okay, so those are just some terms you might, or terminologies you might be bumping into, but they're all indicating the same structure of the market. So now we're going to dive into some advantages and disadvantages. Now, first of all, some advantages. Now, there are indicators that do give a bit more usefulness. For example, if you have the Bollinger Band, typically you would see the Bollinger Bands retrace to lower volatility levels. You do have a clear target, the next support or resistance. Okay, so there is no doubt about that. In that regard, the boundaries are more clearly defined in a way. Now, there are, of course, definitely methods to define targets in trending modes. That's why we discussed Fibonacci's and trend channels, for example. Also, another advantage is that if you do see a range, it could be actually an opportunity to join a trend. So in a way, it's a hidden kind of way of joining a trend. If you have a trend and you see, for example, a range like this, by picking the top of the range, you're actually maybe scaling into the range, into the trend that could continue after that box or range has finished for the continuation there. So here's the example: an impulse down, sideways corrective motion, and a continuation. So you need multiple time frame analysis for that. The disadvantages: you need experience for this. It isn't easy psychologically as well to do this type of trading. There's always the risk of a breakout or a false breakout. As I said, the market is pretty precise, but sometimes you get a bit of a push through that level, So that's always possible. The R2R is good, but in some cases, depending on the size of the range and the time frame, but it is limited, whereas a trend can go on for longer than a range could. And the trade itself can be stuck in a sideways movement, all right? So it could take, a trend is usually faster in its development. A range, it could take a long for these things to develop. All right, in this example, you can see that. So let's move on. Some other keynotes here from Tarantula.
Yeah, other keynotes. So the fact is that the price range most of the time, and that is the true fact. So we need to base our assumptions on that. Most of the time, again, as I say, price ranges because there are bank holidays, because there are consolidations prior to big news. There is also non-volatile hours such as the end of USA session till late Asia session, and throughout the whole Asia session usually. So that is the case. But for us, again, who trade during the London and during the US session, that is not the fact. Okay, that is not the fact, and we can exploit and we can profit from breakouts and from positional trading. So range is identified mostly in the season times and pre-NFP news or any strong news release, because traders do not want to risk anything. Maybe some time ago, 10 years ago, or some 8, 6, 7 years ago, well, we retail traders were minority. Today, this is not the time as it was 8 years ago. Today, it's another time. It's the beginning of new era, because retail traders have all the tools for trading as professional traders have. So the thing is, we can also profit from those volatile and non-volatile times. Simple. When there is no volatility, well, we don't want to trade, or we want to exploit some 5 pip scalps, right? So range trading is the other thing. Who trade the ranges? He usually base his expectations. He based on expectations, on predictions, and less on reactions. I am a reaction trader. My quote is, my favorite quote is, react, don't predict. So reaction, not prediction. I like to react. When I see that the level has been broken and retested and the price is fluctuating around the level, I will react. I will open a trade. When I see that the price is bouncing off the support or resistance, I don't know whether it will go higher or it will fall. I will react. So I usually react. I can make analysis that is based on prediction of the price, but I will react. So it doesn't do any good if I just base my trading on expectations. So ranging is mostly based on expectations that you will pick tops and bottoms. You can pick that, but what if most of big traders didn't pick those levels? You will lose, because there will be a breakout and there will be either a short or a long trade, right? So the simple thing, it's not for beginners. You need a big practice. So if you want to range trade, you need to dedicate yourself to range trade. So you will be a range trader mostly. If you want to be a trend trader, you will expand your skills towards trend trading, right? So those two things are completely different. For me, and my personal opinion is that disadvantage surpasses advantage. So there are many disadvantages in between, and well, for me, I'm not a fan of range trading. Breakouts are the biggest and the worst enemy of range-bound trading. Why? Because if you try to pick the support and if it gets broken, the first break of a big support or resistance is usually very heavy. So it can go 10, 15 pips in a matter of seconds. And you know what's happening last 2 days. The pound yesterday on those news pound initially fell for 30 pips, then it jumped off for some 150 pips. So there are also other pairs which are very volatile, especially yen pairs, GBP, and other yen pairs. So if you want to trade range with the yen pairs, well, you need to have a good and big account. So breakouts are the biggest enemy of range-bound trading, because usually breakouts signal either a continuation, or if it was a range-bound market, it signals the beginning of a new trend. So trend traders and range traders do not trade in those kind of environment. So if you trade a trend, then okay, stick with the trend. If you want to trade the range, you do it, but first you do it on your demo account to see how it goes. It's not the same thing. It's completely the other thing. Those whipsaws make trend traders lose money. Why? Because we trend traders usually lose money when there is a range. It happened to me quite a few times, especially I think it was June or July, I think it was June. There were many whipsaws. So you can see that the price is going up, then it's going down, it's bouncing off the support, breaking the support and resistance, and then it calms, eventually making a range. So what we should do when we see a whipsaw and we lose one and maybe 2, 3 trades in a row, well, we quit the trading. So we want to trade another day. We want to trade endlessly, right? So those whipsaws make trend traders lose money, while range-bound traders make money, because they will exploit those ups and downs. But fortunately for us, there are no many days for whipsaws. There are no many days such as those whipsaws, so we stick to our strategy. Range is accumulation and there is no volatility, right? When there is range-bound market, only if you're trading range on 4-hour and daily chart, then you can say you can trade it. But if the accumulation phase is on lower time frames, especially 15 minutes and lower time frames, where there is no volatility and that is accumulation phase, usually it will start a new trend. Markup, markdown, distribution, you know, there need to be a distribution prior to markup or markdown. So the first thing to know when you see a range market, it will be a big bang after that range. So it will usually be a big bang. Now the range, we cannot count the range 31.50 and the 33 or 34.50. That is not a real range. I'm talking about intraday range. Because most of us are intraday traders, right? So we are talking about intraday range. When you see that the price is going 20 pips up and 20 pips down, it's range. So what you do, I'm not sure whether the price will, for the third or fourth time jump, or for the third or fourth time it will bounce off the resistance, fall down. I'm not sure. I don't know that. No one can tell me that. So I would usually wait for a breakout, right? And when breakout happens, well, we are either, as you know already, we are either trigger happy traders, or we are breakout pull continuation traders. So we can be a trigger happy traders also if we see that the big support has been broken. Usually stops are being collected after the resistance or support has been broken, so we can always exploit for some leverage, I don't know, 5, 6, 10 pips. So that is breakout, right? 15 pips is okay. Range is range. Well, simple as that. Range is range. Either you go 20 pips up, either it goes 20 pips down. There is no pullback. There is no trust pullback, zigzag. There is no trust. So it's a trend. Trend and breakouts are always pullbacks. Remember that. Range is range, and trend breakouts are always pullbacks. After the breakout has been successful, you can trade. You can place another trade if you go with the first trade of the breakout. You can place another trade when the price has been it has already retested that previous support or resistance. So you can go full 2 trades with breakouts, but with range you can go only 1. And if you are correct, then you wait for another channel line to touch, then you can trade it. So trends and breakouts are always pullbacks, and that gives us the edge in trading. Gives us the edge because we can exploit a breakout or we can exploit the retracement pullback. So that is for me big advantage to trend. This is a picture where I show you what is the range and what is trend. You already know that, but let's see the range. This is 1 hour time frame, and you can see the range has been the first rectangle. You see how many candles there are, so that is a range. So how will you trade it? I will show you the way how you can trade it. But this kind of rectangle, I really don't like to trade. I want to see a breakout of that rectangle. Of course, as I already told you, after the range there is a big bang, and you see what the price went. It was around 31, and then it happened some 300 pips up. So you see the range, and then boom, and we have a start of the new trend, right? There is trend, there is thrust pullback, thrust pullback, thrust pullback, and then there is a smaller trend, but it's still a trend because the price is not moving flat. It's not sideways. It goes to the upside. You just place a trend line and you can identify a trend. You don't even have to place your trend line. You can see just if the price is making higher highs and higher lows, it's an uptrend, or lower highs, lower lows, it's a downtrend. But if you're not sure, just place a trend line. You will see the trend. This inner trend is a smaller trend. This big line shows as a major trend. Inner trend is a small trend, but it's still a trend. So you can see the difference. You can exploit the trend by placing a trade on the pullback side. And after that, still again a rectangle. You see how the price was ranging. It was going up, down, and you were not sure if it will go up and down. What about range? It was hit. The bottom of the rectangle. The rectangle was hit for 3 times. Then it jumped up a few times, and then bang again. It broke the trend line and it went down. It was a signal for a new downtrend. So then yet again we have a higher, lower high, lower low, lower high, lower low. So it was a trend. So these 2 rectangles on the chart represent the times when I usually don't trade. I would wait for a breakout, or I will place maybe a trade position based on my bias, whether I'm a bullish or bearish, what my analysis shows me. But to be honest, guys, this range is not good to trade. So my advice is either you practice the thing I will show you later, which is very simple, or you don't trade when you see a sideways moving market. So when there is sideways moving market, stop trading until the breakout happens. So you see how many pips you could have learned on this breakout. A lot of pips, really. You see, this is really a breakout of that range, and there wasn't even a retest, and the price made a new trend afterwards. So this is just a simple explanation of range versus trend. So this is my example. How I would advise you, if you still want to trade with range, this is the way how you can try to exploit the range. And it's done usually just prior to London and just prior to USA Open. So this is London Open and USA Open. We see a 7 London time open. It's a GMT +1, right? It's GMT +1. And you see, well, maybe it's not on this picture, the time is not correct. It was indeed a London Open. So we can say that this arrow represents London Open, and this other arrow represents USA Open. In my country, and that is the Central Standard Time, London opens at 9 o'clock our Central Time, and it's 8 London, and it's 7 GMT. So it's 7 GMT candle. It is London Open candle, but it's still GMT. It's 7 GMT, and it's 13 GMT again when USA market opens. London is GMT +1, and we are still GMT +2. That is the difference. So you just want to wake up prior to London Open, and you want to see where the price is. If the price is close to H3 on Camarillo, you place your short trade. you can put your stop loss just above this H4, or you can go with the tight stop loss, just placing it prior just placing it above the prior swing high. So you can short if the price is around H3, and at the beginning of New York session you could try to long if the price is close to L3. So there is those are the times when usually there is a ranging market, the price is not finished with trend, so we can try to exploit the range. Especially if you see, like on this chart, you can see a hammer when there is a London time, and you can see some well, shooting star prior to London open. So you can do it yourself. Just open Camarillo, and prior to London and prior to USA open, just try to spot. You can see a shooting star prior to London candle. You can see that the price has been rejected of this level 55.80 a few times, and it's very close to H3, so you can place your short trade. And then yet again we can see the hammer of the L3 support when USA open, so you can place a good trade just close to L3. So that is the range trading. You can see how the price has been respecting the range until it was breakdown to the lower side, and yet again the price went up L3, so it made almost full price range to H3. And usually on cable and usually on Euro GBP pair, you can try to do Camarillo trading. If you want my honest opinion, I don't like range trading. I told you many reasons why the traders should concentrate on trading trends and breakouts. So, but if you're still eager to see and to learn how I do it, this is the way how I can place a counter trend. Well, basically range is some sort of counter trend. You expect the price to go, when it falls you buy it, when it goes up you fade it, you go short. So basically I want to see a candlestick formation prior to placing my trade close to H3 or L3. So the trigger for this trade could be indecisive spinning top, or this candle prior to my arrow, it's a spinning top, or a candle prior to that was a shooting star, form of shooting star. And yet again you can see 55.80 how it reacted. It's still Camarillo indicator. It shows you pivot points also, so you could see that, and it's close to H3, so that was a triple confirmation to go short. Also when the price has been close to L3, you could have seen it made some 30 pips at the first touch of L3. Then after the candle has closed, this hammer has closed above L3, you could place another long trade. So that is a range trading. The price is going up and down without a clear trend. But the thing is, we don't know when the trend will start, when the breakout will happen. So the traders usually lose the money. So why I'm advising it only 2 times per day prior to London and prior to USA. If if the price is close to H3, L3, and it has a pattern in itself. So there are conditions to open the trade. London time, London open time, USA open time, price configuration, that means candlestick signal for reversal, and you always use H1 and top of the hour, TOTH, top of the hour. You place your trade after the candle has been formed. You don't place your trade on the leaving candle, only when the candle has been closed. So this is how I can do a range trade if I decide to do a range-based trade. Do you have anything to add, Chris? No, this is not my slide.
Well, I got some
prior to my slide. Yeah. So this was prior to my slide. So this was my last webinar when I showed traders about regular divergence and candlestick patterns. But this is good because Many traders asked me how come that divergence webinar has not been uploaded. Well, to be honest, guys, me and Chris have decided to do that webinar again. So it will be scheduled on Admiral Markets website. I think it will be maybe during this September, during the next month. So we will show you how to do divergence trading. That is very interesting, and I support you fully for divergence trading, and how to use Fibonacci again. So we will use those webinars. We will teach you to do that again, because those webinars have not been made. So this was the last of my slides, this prior slide, Chris. So if you ask me, I'm finished with range trading. So I just wanted to show traders how to trade with Camarillo, because from my personal opinion, Camarillo is the best indicator. It's not a classical indicator, but I'd say that it prints out those levels perfectly. H3, L3 are just great. So you always pay attention to Camarillo. You know, this is one of my favorite pivot points level, and my advice is always to pay attention to Camarillo. Whether you trade range or not, it can help you even on trend trades.
Absolutely.
So
totally agree on that.
Pay attention to that. So here is the Chris. Chris. He will give you some tips about his methods when he decides to use range trading. There are some indicators which he uses. I showed you my way of trading, and yet again, be very how can I say, calm when you decide to do range trading, because an unsuccessful trade of range-bound market can bring you into state of over trading, revenge trading. Don't do that, never. Okay, Chris, you may continue now.
So, well, basically, I wouldn't say that I use range trading. As you know, I'm a breakout trader.
Yes.
So this is more kind of a general information, what kind of tools you could use. But I definitely agree that the Camarillo is a great intraday tool. Absolutely. The ADX is one of the three that I like probably the most, because it does give an indication how strong the certain movement has moved, and it could be a good indication how much momentum is also left, you know, in the remaining breakout. But that's a different story. It also indicates, of course, the fact that there's a lack of a momentum or lack of a trend if it's below 25. We'll give an example of that in a second. But some classical advice that you probably would encounter if you're looking at range trading is, for example, that you want to, of course, identify the key resistance and support levels, and at those levels, instead of waiting for the or actually taking the exact level, you could, for example, wait for crossover of the stochastics, or wait for the stochastics to move out of the oversold or bought levels. Or you can draw trend lines on those indicators. Okay, so those are some ideas you could maybe use and investigate if that's something for you. Also, one tip I want to give is that at Tarantula, I hear an echo, by the way.
No problems, Chris.
Sorry about that.
Sorted, no problems, mate.
One thing you want to look at is to check the market structure on one time frame higher, because what could be a range on one time frame might be a pause within a trend on another. And someone did ask about what if a 4 hours range, but there's a trend or there's a movement on the lower time frame. In that case, I would be more inclined to look at other currency, because I want to see a trend actually on the higher time frame, and I'm looking for a breakout on the lower time frame. So in fact, if there's a trend on the 4-hour chart, but there's a range on the 1-hour chart, then I'm not interested in trading that range, but I am interested in the breakout of that range. So that would be something which would heighten my interest in that currency. Using that, you can using a range actually get a good entry in the trend. Now, when we're doing that, early entry, so it's always more risky. But if you're, for example, in an uptrend and you look for taking a position at the bottom of a range, you're in fact trying to scale yourself in that range. Now, of course, that's riskier because you don't have a confirmation of anything of that level particularly not a candlestick pattern, that would be a confirmation, or a breakout, which would indicate the momentum coming in your direction, of course. So that's what I meant with the entry possibilities here as well. The exact level is early, or confirmation is for example, a candlestick, and then the momentum. So just this is actually what we talked about last week, but it's kind of relevant here as well. You need to know how to identify a trend or a lack of trend to be able to have an idea regarding the trend or not a trend. So in this case, ranges are usually quite easy to see and spot because of the equalness, usually, or relatively equalness in its motion. So a trend definition is somewhat more complex due to the fact that lows and highs usually follow each other in higher highs, higher lows, but there are exceptions. There are phases where the currency makes a bit bigger retrace. For example, I'll give you here a red circle. Are those retracements still, or is the trend changing? So that sometimes is a bit more complex. Here, for example, it's a clear range, clear trend, but within the trend, obviously, you see ranges as well. Actually, that's the same example that Tarantula was using here, funny enough. So here are some examples of ranges again on the chart of the euro-dollar 4-hour in this case, and in conjunction with the Bollinger Band. And you can see that the Bollinger Band does tighten when we do have a range. And you can see that actually, in most cases, if the price were to pierce through one of the two sides, you might get a breakout to that direction. Okay, be careful of a spike like this. That's counter trend. It did hit the Bollinger Band wall, but then bounced off it, in fact. All right. So it just indicates if you're insecure or unsure about if it's a range or not. If you see these Bollinger Bands contract that heavily, then that would be a confirmation. All right, that's one way of doing that. This is just a classical stochastics. Obviously, you can see oversold area or overbought area, and if the stochastics are turning, that could be the signal that that range, or the bottom of the range, or the top of the range has been reached. Okay, so that's one way of doing that. But you can see how, for example, here it's more an area of price than an exact level. So you definitely want to be careful with those stop losses as well, that not a spike like that would take you out, for example. Okay. Here you can see again an example of the ADX and the fact that 25 is one of those key levels in indicating if it's a trend or not. If it's going sideways and around 25, there's not much of a trend, or if it's lower. If it's higher and there's an angle to it, you can see speed, momentum is picking up in up and downside. All right, and then with the green box, ADX is going sideways again. This is the 1 hour chart, but it's definitely something you can use for 15-minute world as well to have an idea if a breakout, in fact, could be a sustainable breakout, or is it going to be a breakout that just goes a few pips and then starts to retrace. If the ADX is above 50, then the likelihood of a sustainable breakout is diminishing. It still can happen, though, because sometimes a move could be very extended. So that's good to know as well. This is the euro-dollar 4-hour chart, and you can see that the previous, let me go back to the previous chart, that sideways box here, this green box right where I have the arrow, keep that in mind, okay? Keep that in mind visually there. And then let's go to the next, this box here, okay? Then let's go to the next one. That box that I had an arrow, that is on the 4-hour chart here. So you have an idea that you can see the higher lows, lower highs, already in the market, sideways box, spike up, and then continuation down. So, you know, this is one of those things that, how do you, this is a very, very small range, in fact, on the 4-hour chart. You know, it doesn't give that many opportunities, because before you realize that it's a range, you're probably here, and you know that doesn't give you much time to actually capitalize on that. If anything, then picking these tops for continuation down would make more sense. You wouldn't lose money on that because you would move it to break even. Eventually, it gets a bigger retrace, and then the continuation down anyhow. But if you were looking for it, this is the 50-minute world of the same box. So all the time we're talking about the same box. This box in the 4-hour chart, this box in the 1-hour chart, all right? Now we're looking at it on the 50-minute world. And if you were to try to trade that, the tops, for example, if you picked a level, you would be looking at these pink, purple boxes if you did that very precisely. If you're looking for confirmations, you're probably taking some candlestick patterns around here with the green circle and the momentum entries upon the breaks, for example. But you can see already the risk involved in that is that you don't get too much of a downside before we just continue in that sideways range. So taking your profit here would have failed because we didn't even reach the bottom. We just continued. You see that? So that would have been a not so successful range trade. But that's just to give an idea of the types of entries. Now, typically the momentum entry is more geared for breakouts and with the trend trades. Okay, momentum entries are not that good for these scenarios, as you can see. This one, of course, would have fared a lot better regarding the range trade. Well, that's just some classical examples here of how you can do it. But for those of you who joined the live trading room, you know that I'm primarily focused on breakout trades. And we do look at Fibonacci levels and assess if sometimes an entry at that fib level or maybe waiting for a reaction of that fib level makes sense. But the main focus is on breakouts. And we look for a break, sometimes pullback, and then continuation, as Tarantula has also been mentioning in the previous part. Okay, so we don't really look that much in range. We did identify a range actually, right on the pound, and it exactly did as we expected, though I didn't want to trade it because it was a 5-minute range, and that was not of much interest to me, as you know. So, any questions maybe from your side?
Yeah, there is a question. What if on 4 hours range, but we can trade trend on 5 minutes? Yes, 4-hour range is a big range. So you have your range, but if there is a trend on 5-minute time frame, you can try to exploit it. And when I say range, I just don't recommend trading any range which is well below 1 hour. So if you have you spot a range on 4 hour, you can zoom into lower time frame and exploit the trend. But that will be a scalp trade. You don't go with full price projection because there is a range, and you can assume that the price will maybe reverse just 5 to 10 pips prior to upper or lower boundary. So you just go for scalps. So you can do that, but go for scalps. And if you see that the price is ranging heavily on every time frame, my advice is not to trade it, especially if the price is ranging on 5 or 15-minute time frame. That is, that is very dangerous, because you never know when the breakout will happen and when that will mark a start of new trend. You can do counter trend trades, you can do trend trades, you can do breakout trades, but range trading is something different. You need to know just pure exact level of that range, and you need to have a view of the channel. But the channel that there is not only you that see the channel, but majority of big bank traders, big traders. So they also need to see the channel you are seeing if you want to have a successful range trade. So that is why I use H3 and L3, because many banks also use those Camarillo levels. You need to know that. So that is why I prefer Camarillo.
In that regard, for example, a day chart range and a 1 hour trend would also be a good example. For example, if you have a big day range, but you can capitalize on maybe some trends within that range on a 1 hour chart, for example.
Also, guys, you know, sometimes not having a position is equal to have a position, is equal to having a position. Because if you, for example, if you decide not to trade a small range, then it will save you your money, right? You need to be patient when making a new position. So don't try, if you want to range trade, then practice it first and be successful at least 3 months on range trading, then you can trade it live. Yeah, and that was it. Thank you for attending our webinar. Surely you will listen to us next Monday and next Tuesday. We will have many more webinars. We will also do, as I said, divergence webinar, FIBO webinar for all of you who want to hear how to trade divergence and how to properly use FIBs. Also, you have live webinar analysis and trading with Chris, Tuesday, Wednesday, Thursday. It gives you everything on London Open, starts at 7:45 UK time, ends at 9:15 UK time, and live webinar with me on Monday from 6 to 7 p.m. Central Time. So we will have a lot to talk about, and thank you for attending. Yeah, another question before we finish it. We need a webinar on trading psychology from Chris and Nenad. It's okay, no problem with that. It's good that you have that you told us. Is it possible to make webinar in London or USA open in order to show us live trading breakouts? We will see, guys. We go step by step. When we finish with our program, then we will see what will be the next step. So be patient. Try to learn each webinar. Try to be as much how can I say, try to be leeches, try to squeeze the information we give you, because there are no many opportunities to learn from full-time traders. Try to leech every information we give you and try to make it a big sample, a big part of that. So we will see. We will see. Maybe there will be some live trading, but let's talk after we finish with our program. Okay.
Yeah, thank you so much, everyone, for joining us today, and looking forward to see you all next week, indeed, at the webinar stated. And psychology would be a good idea, definitely. We'll put that on the list, right? Right, Tarantula, definitely a good idea.
On the list,
so,
no problem.
Yeah. Have a great trading still the rest of the week, and the rest of the month, in fact, and then looking forward to next month. Cheers, everyone.
Cheers. Bye-bye.
The organ